Yeah, I'm losing my
at the
edge.
small exchange, but the most important currently is the newest product that we added, S10Y, Small Treasury Yield, added just this week. I can't believe that it's the same week that this product has launched, because it's been a long one, and it's been received very, very well. A few articles going out, Bloomberg and elsewhere, relative to this new product's launch, and how it has worked to disrupt the treasury trade. A word that you and I make fun of often, but it actually has, in that it's the first product that's priced in yield. One of those things that you think is like so simple, anyone could have done it. Well, we were the ones who did it, and we've got a product, Michael, that ticks with that 10-year yield. Don't have to worry about these odd prices, fractions, and everything else. Very simple, very small product as well, only moving about $40 a day. And I want to tap further into that simplicity and how you can bet on rates going to normal or negative. You look at this chart and you can see where rates have been, and you can project where they're going. But we wanted to dig deeper onto the simplicity of this, Michael. And you actually came up with this idea to talk a little bit about the difference between an index and a future. And here in white, you have the futures on S10Y. In orange, you have the index. Maybe you can give a little color to why this is an important conversation before we start to define these things, because I know you've gotten a lot of feedback. I've gotten a lot of feedback, people asking about this difference. So maybe give a little background to today's segment.
Sure. And the feedback has been great. I think someone tweeted at us like, I can't believe it took this long to have a product quoted in yield. Me either, man. I've been wanting to trade rates for countless years, and finally, this is like the optimal opportunity to do so. So to clear the air a little bit, here we have two lines, orange and white here. White is the actual future. Orange is the index. Now, the index serves a purpose, but you cannot trade the index. The index is primarily to be used as a charting reference, an indicator of where the futures ought to be trading, and most importantly, for settlement. So on the third Friday of the month, all small exchange futures expire, and they expire to a value as determined by this index. That's why they trade in lockstep. But you can't actually trade the index, you just trade the future. And that's why you'll see here in the white line, there are these small breaks in price. And that's because the price of the future is determined by market participants, determined by buys and sells. And those are little hiccups in liquidity that sometimes occur with a new product. The orange line doesn't have those breaks because it's taking a direct feed from a market data provider that's resulting in the actual treasury yield. So you can't trade the index, you can trade the futures, and you should know that they will converge onto each other the third Friday of the month for expiration purposes.
Yeah, absolutely. I'm glad that you did all of that background there. And here are the definitions really quick for index and futures and how they look in most platforms. The index for the small treasury yield product that the small exchanges came out with, usually looking something like this. And then the futures having a slight variation on this. I know some platforms have the forward slash and some have a little bit different look to it. But yeah, the difference between these two things, Michael, great definitions there. A little bit more strict definition is that the index is simply a measure or reference point for anything. Like there's, and this happens in a lot of research, any research papers that you read, there will be a lot of indexes referenced. And in the same way that like you and I go back to this index a lot, like a research report on the state of public health might reference like the Big Mac index, or like how often people are ingesting fast food or something like that. You could, in theory, put futures on top of that index to trade around. Now, something like the Big Mac index, how do you create liquidity around that? How do you find participants to want to trade that just so Joe Schmo can have an opinion on it? That's the tough part. Thankfully, with treasury yields, there are a ton of different places that have some stake in interest rates and in the treasury game. So there's a ton of liquidity there. But yeah, the way that I always think about it, because the by the book way, the traditional way to think about these things with obligations and forward contracts and all these different things, I do away with that stuff and just think of it as like an index is really like anything. It's just a measure of something. And in this case, it's a measure of, the 10-year treasury constant maturity rate.
Mhm.
And the futures are the thing that let you trade on that. Like here is a great example in this product that we launched this week, that the 10-year treasury constant maturity rate here, and I know that's a mouthful, but just think of it as like the 10-year treasury.
Mhm.
Um, it has existed for more than half a century. Okay. But you've only been able to trade it in terms of treasury price futures for a couple of decades. And you've only been able to trade it in terms of yield futures for a couple of days. And so, like, it's this idea of like the same thing with the Big Mac. Like, if someone came out with a Big Mac future next year, guess what? The Big Mac's been around forever. Like, it's been around for decades, and you could track the price from its creation until now. But the futures are what allow you to trade that Big Mac price. And the same thing here with the fact that we're taking something that there's uh, more than half a century worth of data on, and now you can tangibly buy or sell it.
Yeah, so some people may ask, well, what keeps these two in line? If the
Mm-hmm.
index is measuring the price, but the future is determined by the futures price, excuse me, is determined by market participants, what keeps them in line? Well, it's that settlement mechanism. So basically what happens is the third Friday of the month, that future will expire to a value determined by the index. So if you're if you're thinking rates are, let's say, 50 basis points, but the index says 90, that difference is going to be debited or credited from your account. But they should, on that expiration date, basically collapse into each other. So you know that you're getting a simple exposure to the 10-year interest rate. And what keeps it really fresh and interesting and dynamic and representative is that treasury auctions, those happen 4 times a year, once a quarter. Um, we always choose the treasury that is most active, most recently auctioned. So the duration, basically the length of that bond, its maturity date, is always between 9.75 years and 10 years. So you're always really getting the closest to the 10-year treasury yield as you can really possibly get.
Yeah, no, I'm glad that you highlighted all of those things because they're important for sure, and they're good to know. Do you need to like have a great handle on the ins and outs of all of them? No, I don't. I mean, I've been trading interest rates. The first thing I traded out of college, and people would always say I'd be sitting there on the trading desk at the board of trade, and they'd be like, "Oh, there's a 10-year auction today," or "Oh, there's a 2-year auction today," and I knew that that was a thing. I didn't necessarily know what it meant, and I still don't know exactly what it means because it's really complex, and we don't need to go in depth into that. But what you nailed there, and what I love, and what we've been getting a lot of feedback on recently is these indexes and the futures, they have these slight divergences, right? Like because of the difference between participants coming to a new market like we have this week. And you see these breaks here where, man, there weren't participants in there for these couple of minutes because it's a product that has been alive for not even a week. And it takes time to build liquidity and build volume and more participants. And we're confident that this innovative product will do that. But what's great is you just made me feel so much better about the fact that when I see this futures product diverge from the index, like we have seen a couple of times throughout this week, and we maybe will see in the future, but probably not for too long, I can feel confident in the fact that, a lot of people email me and say, "Hey, I think there's something wrong with the product." And it's like, "Oh, no, 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 no. There's nothing wrong with the product. That, my friend, is opportunity," right? Like, because the futures contract is settled to the index, the cash market here. So if it is that third Friday and the futures are trading at $9.70, but the index is trading at $9.50, there's in theory some opportunity in that 20 cents of difference there to get short that futures contract because it should settle at the 950 there. Now, of course, between, if that's Friday at 12 p.m. and the settlement is at, 3 p.m., there's risk in that market just moving higher in that time frame. But we talked about basis trading and offsetting that risk and all those things. Look at past episodes for the ins and outs of that trade. But this is all to say that I can feel confident in the fact that participants will be here that keeping this thing in line. And at the end of the day, it should settle to that index, and I won't have to worry about that 20 cents of difference, because that's how it works on that third Friday, right?
Exactly right. And that's why when you have something like an S&P 500 future, it tracks, I mean, really tick for tick, the
Yeah.
S&P 500 index. You can't trade the index, but you trade the futures, and arbitrageurs and market makers keep those two in lockstep, considering things like dividends and interest rates. So when there's a deviation between the future and the index, just have an open mind and see it in a frame of opportunity between those two prices, knowing that expiration will cause them to converge.
Absolutely. I'm glad that you brought that up. And that can be where we conclude here, because this is a product we're really happy about. And we are confident that it gives you that pure access to this index for the first time in a small and easy to use way. And we're so confident that, yeah, this is something that you and I talk about with a lot of our projects here at the Small Exchange. It's like a mentality. And I think that it's also like an eye-opening mentality for traders as well, is like, when you see something that looks a little off, or looks like, oh man, that's a weird thing there, you're better off doing a little bit of extra research and being like, hey, this might be some opportunity, like we've seen this week in S10Y, and like we'll see in different ways in the future in this product and all the small exchange product that we have here. I mean, we'll have a new product coming probably in the next month. That goes a lot farther of a way than simply making the remark itself. So we hope that you take advantage of all of these opportunities in the new S10Y product. We think the simplest and easiest to use interest rate trade yet.
I agree. A whole lot better than something like TLT that hardly moves, or ZN that can wipe you out. So
Oh my
look at
gosh.
S10Y.
Not even to mention, yeah, the lack of simplicity, not even being able to really grasp what those prices relate to. It's so nice to go to this great website here, Fred, a ton of data on U.S. Treasury bills, notes, and bonds, and all the yields that make up those products, and just say, hey, this this 10-year Treasury rate that you can do research on in the 60s, the 70s, the 80s, and everything else is literally the product here in 2020 that you're trading. Super cool. We're super excited about it. But that is it for Interest Rate Week. We hope you learned a lot